Financing options significantly influence cash flow in apartment investing. Monthly mortgage payments, interest expenses, and loan amortization directly impact a property's profitability and investor returns. Evaluating cash flow metrics like net operating income, cash-on-cash return, and debt yield helps investors assess financial viability and select financing strategies that align with their investment goals. Impact of financing on cash flow. Principal and interest payments reduce the cash flow available from rental income. Larger loans or shorter repayment terms increase monthly payments. Fixed-rate loans provide consistent payments, while adjustable-rate loans may lead to fluctuating interest expenses. Fully amortizing loans build equity over time but have higher payments. Interest-only loans preserve short-term cash flow at the expense of equity growth. Measures a property's ability to cover debt obligations, calculated as net operating income divided by debt service. A DSCR greater than 1.2 indicates the property generates sufficient income to meet loan payments. Formula: gross rental income minus operating expenses. NOI reflects the income available before financing costs and taxes. Formula: annual cash flow divided by total cash invested. Evaluates return on equity invested considering financing effects. Formula: NOI divided by total loan amount, assesses the lender's perspective on risk and the property's income potential. Cash flow analysis is crucial, as it helps investors understand the income and expenses associated with a property. By examining these cash flows, investors can make informed decisions about the financial health and potential profitability of their investment. Ensures the property can generate sufficient income to cover financing costs and provide a return. Identifies financing options that align with investment goals, risk tolerance, and cash flow objectives. Allows investors to compare cash flow under different loan terms, rates, and repayment structures. For example, calculating cash-on-cash return for a property financed with a conventional loan versus an interest-only loan to determine short-term and long-term cash flow implications. How small apartment investors can analyze cash flow projections. Develop cash flow projections. Use market comps to project rental income for all units. Include costs such as property management, insurance, taxes, utilities, and repairs. Incorporate monthly loan payments based on interest rate, term, and loan amount. In this section, we'll compare different financing scenarios to help you understand the options available. Let's start with a conventional mortgage. You'd typically need a down payment of 20%. The interest rate is fixed at 5% over 30 years. This means your monthly debt service will be higher, but it will remain consistent over time. Now let's look at an interest-only loan. Here, you also need a down payment of 20%. The interest rate is 4.5% for the first 5 years, which is the interest-only period. Your monthly debt service will be lower initially, but it will increase after the interest-only period ends. Calculate and compare metrics. Net operating income, or NOI, reflects income before financing costs. It's useful for assessing property performance regardless of loan structure. Cash-on-cash return measures return on equity. Interest-only loans may show higher short-term returns. Debt yield assesses whether the property's income justifies the loan amount. Conduct sensitivity analysis. Evaluate how changes in key variables such as interest rates, rent growth, or vacancy rates affect cash flow and returns. Compare the break-even occupancy rates for different financing options. Example: cash flow analysis for a multifamily property. Scenario: property purchase price, $1 million. Gross rental income, $120,000 per year. Operating expenses, $40,000 per year. NOI, $120,000 minus $40,000 equals $80,000 per year. Loan amount $800,000, which is 80% loan to value. Interest rate 5%. Monthly debt service $4,295. Annual debt service $51,540. Cash flow. After debt service, $80,000 minus $51,540 equals $28,460. Equity invested, $200,000, cash-on-cash return, $28,460 divided by $200,000 equals 14.2%. Loan amount, $800,000, which is 80% loan to value. Interest rate, 4.5% during the interest-only period. Monthly debt service, $3,000. Annual debt service, $36,000. Cash flow. After debt service, $80,000 minus $36,000 equals $44,000. Equity invested, $200,000. Cash-on-cash return, $44,000 divided by $200,000 equals 22%. The interest-only loan provides higher short-term cash flow and cash-on-cash return. The conventional mortgage builds equity faster, offering better long-term returns. Evaluating cash flow implications of financing options is essential for apartment investors to assess property viability and optimize investment returns. By calculating NOI, cash-on-cash return, and debt yield under various financing scenarios, small apartment investors can make data-driven decisions that align with their cash flow needs and investment objectives. Comparing these metrics across financing options ensures that investors select strategies that maximize profitability while managing risk effectively.